Futures this morning are pointing to a triple-digit gain at the start of trading this morning. We're looking at a rally underway this morning following a mixed story yesterday. The Dow Industrials right now up 200 points. That's 2/3%. The S&P 500 up 24, and the Nasdaq higher by 52. We are awaiting Federal Reserve commentary. It will conclude its two-day meeting. That's the September meeting. We'll hear from the Fed at 2:15 p.m. Eastern this afternoon. Investors are anticipating to hear some details on when the central bank begins the tapering plan, which Federal Reserve Chair Jay Powell has said could begin by the end of this year. Joining me right now is Potomac Wealth Advisors President and Founder Mark Avallone, also joining the conversation all morning long this morning. Is Optimal Capital Director of Strategy, Francis Newton-Stacy, and Republican strategist and lead attorney at the Madison firm, Jonathan Madison. Great to see everybody this morning. Thank you so much for being here. Mark, kicking things off with you here, waiting on the Fed. What do you expect to hear?
Well, I think we're going to hear a lot of what we heard at what was called Jackson Hole, where Jerome Powell realized the tone and tenor of his words were going to be super examined by every market participant in the beginning of what looks to be a slight tightening cycle. The last time he tried this a few years back, it didn't go so well. This time it went very well. He was very measured, and this is what the markets want to see. I don't think investors are going to be fearful if at this point there is a slight taper that starts in November, December, or January. What they're concerned about is the pace of such a rate hike. Remember, markets do very well historically during the early phases of a rate hike cycle because the underlying economy is strong enough for the Fed to have made that decision. So I think really what we're going to look at is the timing and the pace of it, and if it's measured, and if it is, it might actually be in some way a net positive for the market.
Yeah, and then, of course, there's the Evergrande situation. This is the Chinese property lender, the most indebted company. It has announced it will pay an interest due on one of its bonds that is due this coming Thursday. Investors are keeping an eye on this, but they're in the dark on the second bigger payment, also due this week. The Chinese real estate conglomerate not elaborating on the terms of this payment, but according to Refinitiv, the interest it owes on this bond is $36 million, and it will be paid. There was a negotiation underway. Perhaps this has calmed things down in the China market and certainly in the United States as well. Is this less of an issue here now? What's your take?
Well, it's less of an issue here, though the timing is interesting because I'm sure it's on the Federal Reserve's mind, and they wouldn't want to begin a tightening cycle with this huge unknown out there. But in terms of how the command economy works in China, they're not going to let this melt up for a variety of reasons. Property is a huge part of their GDP. It reaches many areas of their society. What they might do is clamp down on excessive capitalism, what they consider to be excessive capitalism and profits, especially in the real estate sector. They're unhappy with how real estate is priced in these cities, and they may use this as a chance to re-engineer internally. But I don't think it's going to be a chance for them to punish capital markets because they're also a big player in that space, and they're going to want some stability and continue to be considered a leader in global commerce.
Yeah, I mean, I guess the worry was that there was some kind of a contagion effect from Evergrande and its inability to pay its interest payments. Is that no longer a concern for Wall Street? I also want to ask you about the earnings period. You've got FedEx reporting earnings, saying that staffing problems hit the company's earnings in the quarter. The company missing estimates. And take a look at the stock this morning as FedEx lowers guidance for 2022, down 5 2/3% this morning. Meanwhile, Disney is up right now, up 1%. But it was down yesterday after CEO Bob Chapek projected lower fourth quarter subscription growth estimated for their Disney Plus platform. Mark, your thoughts on what we're seeing early on in this earnings season here?
Okay, on the first one, no, this is not a Lehman moment for Evergrande, and the global economy is going to withstand this, and China's going to take action. So I think it's a good story. It's an interesting story. It's a wake-up call, but it's not going to be contagion. FedEx and Disney are very different. FedEx is struggling with what a lot of other companies are. It's a labor-intensive business to some extent, especially with the packing and the shipping, and they're struggling with finding labor, and they're paying more for it. It's not unexpected that their bottom line is affected. My stance on that is it's going to be more of a one-time this year shakeout, and hopefully we have a more normalized economy next year, and companies are not perennially in this situation. Disney was a bit of a surprise. Disney has turned into a growth stock along the lines of a Netflix, where it was a streaming service and it was priced like a streaming service. That's what the move in the stock was all about in the past 12 months. So pulling back on those near-term projections would send the stock down. However, if you noticed in the notes, the 2024 projection, at least for management, retains the same level of online subscribers. So I think this could be more of a short-term blip from the subscription service, and other areas of Disney could also do well. Next year is a big, strong movie rollout lineup. A lot of new content will be coming on next year. All the parks will be open next year. Paris still isn't open, but that will come online eventually. And I think that they're also recognizing some charges for closing Disney stores right now. So this was a mixed bag of an earnings report, and I think they dumped a lot of the bad news into it. I'm not sure. I'm pretty confident in management that they may turn the corner going and looking forward.
Mark, real quick, have you changed your allocation at all? You still want to buy stocks at these levels?
Still optimistic. The Fed has been the biggest story. They will continue today to be the biggest story. Still like big tech, concerned about non-cash flowing tech, speculative companies. That's the area I would suggest investors stay away from, but broadly diversify, include technologies. And in the beginning of a slight rate tightening or a rate hike cycle, also looking at some financials who may benefit from some Fed action down the road.
All right, Mark, we will leave it there. We got the 10-year Treasury yield right now at 1.33%. Talking about rock bottom still. Mark Avallone, great to get your insights this morning. Thanks very much.